Manpreet, this aggressive US trade policy that we are seeing is clearly aimed at galvanizing support ahead of the midterms, which tells me that this unsettling trade narrative is going to run until at least November, possibly even beyond.
Well, possibly, yes. But I suppose that exact argument you can read on the opposite way as well, where we've got some escalation so far, quite a bit of posturing. But then if midterms are the target from an election perspective, then that also imposes a deadline to at least enter negotiations or potentially even reach some sort of interim settlement. So I suppose we need to be careful with that risk. Absolutely continued escalation and getting caught in that loop, it's not a good outcome. But if the midterm elections are one catalyst that help bring the two parties to the negotiating table, at least start hammering something out, that might actually be quite a positive catalyst after all the pain we've seen so far.
Can I tie this back to the data and earnings importantly as well? Because the PPI numbers in China and the US, they're already arguably reflecting the cost pressures which could worsen. So that means potentially margin erosion. Is there a risk that the earnings narrative that's been such a central pillar for this late-stage bull rally is in danger of falling through?
Well, that exactly is the risk. And I suppose think about how that would translate into markets. So I suppose less so the headline earnings number, that's where the corporate margins actually become the most important indicator. Because we do see some of that start to come through. You'll see it in terms of cost, whether firms with pricing power, whether they're sort of acting to raise prices to protect margins, or are companies, taking the hit on the margins. We're not seeing that so far at an aggregate level, but agreed, that would be the one number to watch, but whether we're seeing any flow through from trade tensions.
Anecdotally, what are you hearing from your corporate clients? Are they looking to preserve capital? Are they keeping their powder dry? Are they basically in a very cautious posture? Are they reluctant to deploy capital and hire until all of this dust settles?
Well, without commenting on individual clients, of course, I think, look, if you look around this region and look at, the narrative coming out of at least the large players at an index level, the trouble is there are a number of sort of factors at play. So trade tensions, of course, are one, and people are worried about them in multiple ways. But ultimately, if you look in China, for example, that's also being offset by domestic credit tightening as being one risk. We go to India as well, corporates also grappling with, higher interest rates and, in fact, high rates, net of where the inflation rates are, and, of course, constraints on the banking system. So the trouble is,
so you've got cost of funding issues as well on top of that.
Exactly. So it is hard to isolate. And that's where, as an investor, we think looking at the aggregate measures about is it feeding through to inflation, is it feeding through the margins, that may actually be the most effective way to think about how it would impact investment portfolios.
And so far it hasn't, but it's going to be a big issue for the policymakers like the Fed.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.